everyone, welcome to MyFamily Pod. I'll be speaking to Jenni Macdonald Sykes and Liz Grimshaw of Revival Financial Planning about the importance of financial planning in divorce, cash flow modelling, mortgages and pensions. Hello everyone, I'm here today with Liz Grimshaw and Jenni Macdonald Sykes from Revival Financial Planning. If you'd like to introduce yourself, ladies.
Yeah, so hi, I'm Jenni. Thanks for having us here today. I am a chartered financial advisor and I've been working as a financial advisor for many, many years. And about 4 years ago, Liz and I met, didn't we? And we both sort of decided we had a bit of a passion for wanting to help people make the most of their money and particularly help people with sort of divorce financial planning.
Morning, I'm Liz. Thanks for having us. So I retrained as a financial advisor about 5 years ago, just before I met Jenni. And it was a career change for me. I'd worked in the city, but wanted to retrain and do something different. And yeah, Jenni and I met at a workplace and we had chatted about the difference in, different specialisms that we could have within financial advice. And we both decided that actually we could make quite a big difference when people are going through divorce.
Or building a new financial plan for the future.
Brilliant. And that's how we know each other, because obviously at Myerson, I'm a family lawyer and we have a family team here specialising in divorce and family separation, and often need your services to help with our clients going through that and the financial advice they need at the beginning, in the middle and the end of that process. And how we can help each other, what we'll talk about now. So divorce and the division of financial assets often requires assistance from financial planners, financial advisors, especially when it comes to cash flow modelling for a client. So, for example, they are in a situation where they are looking to divide their assets and trying to negotiate a settlement with their spouse. They may or may not be in court proceedings by this point, but they are looking at figures. So, for example, they're looking at selling the house and they might have a cash sum and a lump sum payment coming to them or hopefully coming to them, and they want to see how much they need to be able to move on with their lives. And that's where they need a cash flow forecast for their future. They might be in their 40s or 50s, they might have young children, they might be looking to retire in the next 10, 20 years, and they really want to see how much money that they will need from their divorce to be able to have a comfortable standard of living if possible. And that applies to both husband and wife, both sides. So tell me about how you can help those people going through separation who need cash flow forecasting, and what does that involve from your point of view? Like, how much detail do you need to go into, and what does a cash flow model look like?
So every client's different, and everybody's situation is different. Sometimes we might be looking to give someone peace of mind. Sometimes they might need a bit of a reality check. But the way that we work is that we would talk to them about their current income and outgoings, and it may be that following the divorce, that would look a little bit different because they might be needing to sell a family home or whatever, depending on the situation. So we'd look at income, outgoings, all of their assets, and then we'd run a model and show that, right, okay, this is where you're at. This is perhaps a proposed settlement, or these are the ideas that you can put forward in terms of a settlement. And it's often a three-way conversation, isn't it, Jenni? We'd look at it like, with the client, with the solicitor, this is what's perhaps realistic in terms of a percentage split, family home, assets, pensions, and then model that and see where the gaps are. Perhaps the client might need to adjust their expectations in terms of spending, or it may be that they need to push for a bit more in terms of pension share. We can advise that, and we often run several models, don't we?
Yeah. I'm going to ask about the models and how many models you might get us to run.
I think because often we get involved at the beginning of the process, so then we might be running the initial models and, this is what we think, or this is what they think settlement might look like. But then with all the back and forth and the negotiations, it's sort of, okay, well, the other side has offered this. How does that look?
Yeah.
Will I be okay with that sort of settlement? It's not quite right, so we're going to go back and offer this. How does that look? And it's just giving that peace of mind of not just what the figures are, because sometimes the figures themselves are quite overwhelming, but putting that into a model that's visual, that allows someone to see what the long-term outlook looks like, and that actually, in most cases, they are going to be okay. They might have to adjust expectations a little bit, but actually they're going to be okay going forward. sort of making sense of those blunt figures sometimes.
And then do they are they sort of long reports, or they used? I'm guessing they'll be user friendly, not just for the solicitors but for the actual client themselves, so they can see in black and white how much money they would have on a yearly basis, for example, if they, to supplement their income.
Yeah, I mean, the reports, the kind of model that we show run from their age today up to 90 and 99. So it's kind of, a whole lifespan, and they're often very conservative in terms of spending and also asset and investment growth.
Yeah. You don't know what's going to happen in the market, do you? You have to be conservative in these things.
Exactly. And then we'll run several models and then we put those into a report. But we run them, put them into a report, but then we'll have either a in-person meeting or a Zoom meeting and run through it with the client to make sure that they understand. And then that report is passed to the solicitor as well, so they can see our, different options. And sometimes they've had an offer in from the other side, and we'll model those as well. And then they can see how that looks.
Okay, that's good. And what sort of questions would a typical client of yours ask? Those things that, would they ask things like, will I be able to afford a house, or will I run out of money, or will I be able to retire by age 55? Do you get these sorts of questions?
All the time.
Yeah,
definitely. Yeah, will I run out of money is probably your biggest question. Will I have enough? And I think, what does retirement look like? Because it's all very well worrying about the situation right now, but actually, what does it look like 10, 15, 20 years down the road? And will I have to downsize at some point to make things work? Those are all common questions.
Yeah, and that must be quite a common part of someone's plan, potentially if they've got young children and they have a big house at the moment. They must, some people must think, I am going to downsize when the children are at uni or after that point. And although that's a harsh reality of it, I think more and more I'm seeing that people are factoring that downsizing into their cash flow forecasts.
I think they have to. I think the cost of living is expensive.
Exactly.
And if people are on the younger side when they're getting divorced and they need that share of the family home to be a bit larger and perhaps take a less of a percentage of the pension, then we factor in downsizing, and we model that quite often, don't we?
Yeah, because you've got to factor in the potential price increase of their current property. And it must be so difficult to do that from your point of view, to forecast that and then forecast the house price rises in the next 10, 20 years. It's very difficult.
Yeah, I mean, we have to use assumptions in terms of property growth. And again, we're relatively cautious with that. And then the modelling sort of does all the thinking in the background for us.
Okay. Is it like an AI system you use?
It's not AI, no. So we plug all the input in, and it's got all the tools in the background to work out the inflation and so, forecast everything forward.
Yeah. And every client's different as well. Some of them have got their spreadsheet and they know this is what they spend on direct debits and this is what the kids cost them and this is what they spend on food. Some people haven't got a clue. So, our help in the early stages varies quite considerably depending on the client.
Yeah, I have clients that you ask them to fill out a schedule of outgoings, a monthly outgoing schedule, and they really don't know what the basic outgoings of the household are. So it could be like the water rates or the council tax, and I'll get it back, and it'll be like question marks. Like they won't know. I did one yesterday like that, and I was trying to then guess and look at council tax rates in their area, because we're doing a Form E and it needs to be accurate. So we have to sort of make assumptions as well about what their expenditure. And again, I'm conservative on that because I sort of overassume what their expenditure might be sometimes because, only today in the news, water rates are going to be going up by £168 a year per household on average. And you have to be quite careful when you're forecasting for the, you put on the Form E future costs. Well, electricity and gas have gone up fourfold in the last 3-4 years. It's very difficult. We used to be able to put like £50 down for each and that would be enough. And now it's more like £200 down for each. And it's because that person might not have any knowledge at all about what's going out of the joint account, doesn't have any visibility, or perhaps the bills are all being paid from their spouse's account. And it's shocking sometimes that they don't know what they spend on food, and it makes our job quite difficult. And until we get the disclosure from the other side, do we get a true picture? But at that point, we've already had to do one Form E. So we've had to make assumptions, and then we get questions back from the other side saying, how can you assume that it's only costing this? I say, well, we didn't know till we saw the bank statements what he or she has had no visibility over what's been spent in this house, and sometimes it's a bit of a shock. And only then can a financial advisor assist, really, because you need the figures of what the outgoings are. Particularly if, say, the wife might want to stay in that home and perhaps she didn't know what the expenditure was, the reality might hit home that actually she can't afford to stay in the family home, like needs to be sold. And that's quite a common scenario, initially.
We often have to sort of sense check budgets as well. So we look at them, the budgets that clients might present to us, we'll go through it. And often there's categories which we feel are probably missing. So common one is maintenance on the house. Yes. People don't think about that because it's not a regular outgoing, but actually if you own a home, there is going to be regular maintenance that you need to account for. That needs to be part of your regular outgoing.
We have that on our standard schedule that we send out to clients. We have that on there. And sometimes they go, what do you mean? I'm like, well, if you had a roof repair once a year, it would cost this. And there's so many things that can go wrong. Your washing machine can break. You might need a plumber. Your boiler could pack in. You have to assume, just like with a car as well, you have to assume repairs on an owned car. If it's not a lease or where you've got any service package, you need to assume there'll be repairs or MOT charges. So the list is so long about what they have to think about, and I think they really struggle sometimes in filling that in, which is why then I have to sort of guess what they might spend on a conservative basis. But until you get to that point, you really don't know what figures you're working with to have an idea about what the outgoings are versus the income.
Yeah.
I was going to ask as well with your reports, how do you factor in longevity with men and women? How do you work that into your reports?
We just do them both to 99.
Yeah, I tend to go to 99. I mean, you can also look at the Office of National Statistics. So you get the average life expectancy, but we'd usually be cautious and go the higher level, because you usually get 3 years on that.
Yeah.
So you'd usually go at the higher one, just for cautious purposes.
So but a standard, you'd go to 99 anyway, which is good for anyone. Okay. And priorities as well. So someone might come to you and say, well, my absolute non-negotiable is 2 holidays a year.
It might be that once, or people having to maybe get a job and they haven't had a job before. So they might need to scale back on some of these things. Then once they've got a job, then they can come back.
I think some clients do really get it and they understand that the situation is changing significantly and they will need to cut back. And other clients aren't quite there yet.
Yeah, we find the same. Yeah, difficult to have those conversations. But for anyone in our space, really, isn't it? Like we have to have those conversations quite a lot, or about going back to work, or increasing hours at work to be able to afford. And actually, that sometimes if you're not working in a case, but you can work, so the children are all at school, for example, it doesn't look great if you're asking for maintenance if you're not working. Even if you work part time, does you wonders in your case and can help your case for maintenance, because yes, there'll be an acceptance that the earning capacity just isn't there compared to the other spouse. So the other spouse could earn 6-figure salary, never going to earn that if been out of work for 10 years, perhaps don't have the same skills, or trying to get back into something they previously did in a previous life. The salary is going to be quite low. But if you do show willing to work even part-time and you're claiming maintenance, you have often a higher chance of success on your maintenance case.
Yeah.
And that's quite a common feature, and having those conversations about going back to work are really difficult.
I think that is where the modelling helps, because if you're modelling someone's lifestyle and there is a clear shortfall, being able to say, well, look, if you did get a job and you were earning this much, look at the difference it makes. And I think that does help with the reality check. Same with expenditure. If you're saying you need to spend this much, well, this is what it actually looks like, and the money isn't there necessarily. But if you cut down to this much, then you can sustain your lifestyle. So that, I think, helps with the reality check maybe.
Yeah, and we'll run 2 or 3 different scenarios, won't we? And sometimes with jobs as well, if you've got a job and you perhaps earned X, this is how it's going to look. But if you could perhaps work a little bit more and earn Y, then, it's a positive effect on their cash flow. And it does help people kind of think about it.
Yeah, even increasing hours from 3 days to 4 days a week, makes a huge difference. It can do. So that's something that we always look at as well with the assistance of yourselves. And then the other side of things, where we look at cases, it's most in voluntary disclosure, and also when you're in court proceedings, the court wants you to obtain evidence of your mortgage capacity to see what you could borrow. So whether you're working or not working, you still need to produce a mortgage capacity report, even if it says 0. You still have to provide one for the FDR hearing and the final hearing. And can you help people with mortgage capacity reports?
Yeah, definitely. We write a lot for courts, and again for varying different types of clients. Some that aren't working, some that are based on maintenance, because some lenders will take maintenance into account in terms of borrowing. Obviously, it depends how much that maintenance is and how long it's going on for, as to what the lender's happy to include. But, there is an option for that. When it's coupled with a job, it's seen as more favourable. But yes, you've got both. And then often we get asked to write and comment on the other side. If there's a capacity report come in preparation for the FDR from the other side, we might get asked to write a commentary on what we think, particularly if you're perhaps thinking, well, that's not really their mortgage capacity, or perhaps might be a bit discrepancy in the values.
Yeah, that's great, because sometimes we get them back and we think, oh, that doesn't look right. You might have someone earning quite a significant amount and the mortgage capacity is quite low, tactically low for the case. It's good to have a second opinion. Do the mortgage companies that take into account child maintenance, do they need a court order, do you know? Or can it be a child maintenance assessment in accordance with the child maintenance service, as long as they're in receipt of it and it's going into their bank account?
So it depends on the lender. Okay, and they all have different criteria. It's like with just standard borrowing with your base plus commission or base plus bonus, they all have slightly different criteria. So I would always, in a report, include a range of what they might be able to borrow. But yes, so some lenders want to see a stamped court order, and others want to see the last 3 months of it going in.
It makes more sense from, and I'm not a financial advisor, or a mortgage advisor, but from from our point of view, a child maintenance order is only enforceable for 12 months in a court order. Then it falls back to the CMS, a government agency. So if lenders want a court order, it doesn't really mean very much. It gives them a year of security. That it depends if the person that's paying is going to pay. If they don't pay, the order is only enforceable for 12 months, but then the jurisdiction falls back with the CMS anyway.
Yeah.
And it is iffy, because if the person that's paying ends up going self-employed, earns much less money or puts less through the books or is out of work completely, that just stops. So it is risky for lenders, I suppose. Maybe they'll lend on a shorter term. It just depends on...
Really depends on the whole situation, where the person receiving maintenance is also working, whether their income's likely to go up.
And it's supplementing it rather than the only...
Yeah, sometimes if somebody's, earning a low income, got high maintenance, that you wouldn't be able to max out on the borrowing maintenance because it's too risky.
Exactly, because we have lots of situations where people apply to vary maintenance orders, or people come to us because their ex has stopped paying and it's an enforcement application, whether it be spousal maintenance, in that situation. So it is risky. And then even a change of circumstances for the payer. So if they have more children, it will reduce the child maintenance service rate for them to pay for their other children. So that's you just don't know. Look, if you're a young family, that can happen. It's quite difficult, a difficult job for you and a lender to.
Yeah, because whilst you're looking for them to be able to have the ability to borrow, you don't want them to be able to borrow too much and then end up in a nightmare situation.
Exactly. And then mortgage capacity reports, obviously you prepare them and they can be used in proceedings for solicitors, which is really helpful. And one thing I have noticed recently in cases are mortgage rates affecting the ability of couples to separate, rehouse. They may have been on a low deal for a long time, and then the rates obviously jumped up, and they're kind of settling now at a level, but they're never going to be what they were. And a lot of people this year again will be coming to the end of those low 1% or below 1% deals, and are being in difficulty if they're thinking of separating. If they're not thinking of separating, but if they're thinking of separating, even more so. So have you noticed that that's causing issues for lots of your clients in terms of being able to separate their lives and buy 2 homes, not one?
Yeah, definitely. And, you look back at some of the reports that we were doing 4 years ago, and people's, ability to borrow and what those monthly repayments look like compared to now. You had people being able to borrow at 0.89 or whatever, and now it's around 4%. It's lucky. So it is a huge difference.
And it doesn't sound a lot, but it is on a average to large mortgage. That's a lot of money coming and makes it unaffordable. And I think actually it's trapping people in marriages at the moment. It's probably not, my sentiment probably isn't shared, but I do think there's a trend at the moment that the people aren't able to actually move on.
Yeah, they can't actually do it.
Finances just won't, without a huge drop in lifestyle, which is what they have to then think about, which is really the reality is awful for them. But I have noticed that this January, I've noticed it more so. And there's not that drop I thought that there would be last year with the mortgage rates. And there isn't going to be probably this year either.
No, they need to come down to, I don't think they'll come down to, I'm not don't work for the Bank of England, but, I don't think we'll ever see sub 1% again.
No,
But it'd be nice if it could come down to 2.5%.
People overstretch themselves, but they didn't think they were overstretching themselves when they were on 0.8 deals, and now the reality is hitting that it's a lot per month to sustain, especially if you're thinking of separating.
And as you said, there's a lot of people coming out of those deals now.
Exactly.
Who are hoping that rates were going to be a bit...
There's a real crisis, and it's really difficult. And houses, because of the rates, aren't really selling now in some areas of them, and that's the other problem, isn't it? So it all impacts on separation and divorce and the ability to do that unless you're willing to downsize and lower lifestyles. And you may have already done that, of course, because your mortgage has gone up so much. But it's factoring into our cases, definitely.
And with properties not selling, and we've got clients who have settled and the financial order's in place, but the properties aren't selling, so they're stuck. I mean, is that marital home still waiting for the property to sell?
But both of them living there. We have a case just like that, actually, and the house has been on the market for over 12 months, and it's now been reduced. Problem is, you have a RICS report done at final hearing which says it's worth this amount, and actually the reality is it's not sold, so you're dropping it, and then it's affecting the whole settlement. So again, your services would come in again to say, actually, how much can we actually drop this house so I could afford to live? And I'm finding it difficult where perhaps they've had an order previously 4 years ago, whenever it was, that says they're to receive a specific lump sum from the house, which then crushes down what the other person's going to get. So they're reluctant to reduce the price. If it's a split on percentages, it's easier and fairer. But if you've got someone say, well, I'm going to be getting, let's say, for example, there's 200,000 in a house and someone's receiving 150 of that, well, that's all that might be left if you're dropping your house price, just as an example. So that can happen as well. And then now let's talk a little bit more about pensions and how you can help solicitors with pension sharing. So typically in a divorce, you will have a situation where one person will have a higher pension pot than the other, perhaps because they've worked more or had a better job, or they're older, and that needs to be shared on divorce with the other person to equalise pensions in retirement. At the first stage, we may get actuaries to do a report on what percentage of the pension would need to be transferred to equalise pensions. There might be multiple pots, and those reports are really difficult to read for anyone who's not an actuary. They're really, they're very complex and technical, and sometimes we need financial advisors to interpret them for us. So is that something that you can do with clients?
Yeah, absolutely. So pensions are sort of my forte. I'm very kind of au fait at looking through the pension reports, understand, like breaking them down and picking out the key points and helping explain that to clients. And
sometimes I just go to the conclusion and think, I'll read that first and see, and then I'll read back through the whole report and try and make sense of it. But it's often the case I do need a financial advisor on the case as well.
They're so lengthy and there's so much information in there. And it's hard to pull out the key.
Yeah,
the key things.
It is. Multiple calculations as well.
Yeah.
Different ages. Yeah. Sometimes you'll have a calculation for separating out the pre-marital pension versus the pension accrued during the marriage. So there can be 4 or 5 calculations in the reports, which judges do not like, by the way. The people still ask for multiple calculations. I understand why. Yeah, so that can be quite difficult. And you can get reports about 60, 70 pages long, and they cost a lot of money to do. But you do need them. We can't advise on pension sharing. We can't, we're not able to. We're not financially qualified. So you do often need help from pension actuaries or advisors, and then financial advisors as well. And
I think it's highlighting the advantages and disadvantages of each option.
Yes.
And particularly when, might have someone where part of the pot's been crystallised, so part of it's been used, or some of the tax-free cash has been used. All of that impacts what happens next. So.
Do you ever find that one spouse, perhaps the one without much of a pension, had no idea that their spouse had taken such a huge lump sum at the point they could crystallise part of it? Yeah, and it's very difficult to have those conversations as well with people who have got the majority of the pension, because part of it will have been accrued before they even met usually. And you do get it sometimes where the person without the large pension will sort of sit back and go, oh yes, they should keep their pension. They're attached to it. And
also I think that particularly with final salary pensions, defined benefit pensions, where it's a guaranteed income for life,
yes,
a lot of time people don't realise the value in those pension pots and how valuable they actually are.
Yeah.
And so that's part of our role as well. It's explaining that actually there's big value in that pension.
Because you could have a situation where if there's no pension sharing, that you've just got the state pension to rely on, may not have full contribution to that either, so they may not get the full state pension. And you have someone with a final salary pension, multiple pots, and can live very comfortably 60 plus, and the other person's really going to struggle. And that's how I sort of explain it to people. Look, if you'd stayed married, this is the lifestyle you'd have had, but you've been married for 30 plus years. It's sometimes you're convincing people to seek a pension share, believe it or not. They very much, I don't want to touch it, it's theirs. Other times it's very different. It's rare with pensions that you see someone, a couple, just, willing to go to an actuary and get a report to share it. Very rare. Sometimes a pension pot's worth more than the marital home.
Absolutely, yeah. And I think that goes back to the modelling as well. So being able to show the situation in retirement, and for people who are saying, no, I don't want to touch the pension, that's okay, they can keep that. Or actually, this is the difference it will make. And we're also modelling, okay, well, if you offset the pension, that works right now, but you need to be aware that in retirement it looks like this. So what would it look like if perhaps you bought a smaller property and retained your share of the pension? Does that look better overall in the long term?
And it's then their decision whether they do that option or they do I'll have the big house now, less pension, and downsize if I need to.
And sometimes people, particularly if they're maybe still in their 40s and they've got 20 years to work, they're a bit happier to have less pension because they think, well, I'm going to go back to work and I did have a good job before, so actually I've got time to put money back in that pension. But right now, a bigger home for me and the kids is more favourable. So it just, everybody's situation is slightly different. Whereas if somebody's kids have grown up and gone, then actually they don't need the bigger house. They need more pension.
So it's the production of the Pension Advisory Group report. They've done 2 reports now. I've noticed that judges are, even on a consensual basis, when we send a consent order in, which doesn't provide for adequate pension, they are rejecting consent orders on the basis that there's not adequate pension provision. More and more than I've ever seen before. And even if parties are young and have got 20, 30 years ahead of them in their careers and can build up the pension, judges are still reluctant to rubber stamp an order which does not share the pension that they've from their spouse, that they've perhaps been in a marriage for, say, 10 years, got young children. Even in that scenario, the judge is very reluctant to rubber stamp an order, and you find yourselves how, if you've got a client who's particularly set in their ways and has said, look, this is what I want to keep more of the house now, I don't want the pension now, that this is what is important to me right now, and you explain the rationale to the judge in the D81 form that we have to send in, which is a detailed form of the snapshot of what they've agreed and what their assets are. Even if you explain to the best of your abilities, still getting knocked back and sometimes asked to go to a hearing so the judge knows that the person who's giving up their right to pension knows what they're doing. And that it's called a mention hearing, and we have them more and more.
That's really interesting.
It is. I've noticed it quite a lot recently, more than ever.
I think there's been, since the pension advisory report, it's just, pensions are just a hot topic, aren't they?
They are.
People realise now how important they are, and I mean, what big value they can represent as part of the total pot.
Completely. And there's when we were talking about calculations before of calculating what someone earned and by way of pension before the marriage, and people tried to exclude that from the calculation. That isn't favourable with courts. It's the pension advisory reports and pension advisory report, because it says in the report that in a case where the needs require the pension to be shared, so perhaps the other person has no pension at all, so of course needs require the pension to be shared, that post and pre-separation accrual should not be taken into account. It's just the whole pot. It doesn't matter. And also the length of the marriage isn't given as much weight as it used to be. So if it's a short marriage, you're still looking at potentially receiving an equalising pension share, which is a big shock to some people. And unless you're going to try and agree out of court, you could be faced with the risk that it's within the possibility that a judge will order an equalisation of pensions. It's within the realm of possibilities, and that's the risk of litigation. And that report hasn't really helped those people who want to keep hold of pension, perhaps that they, in some cases, were paying into before their spouse was even born, when you've got an age gap. Yeah, in a couple, that happens. I've had people email say, I brought this pension into the marriage, but I earned half of it before my spouse was even born. And that situation, and it seems so unfair, but it's if it's a needs case, and unfortunately it would have to be shared. And you just hope that those cases can sort of come to a deal without having to spend thousands getting to that point with a judge faced with that reality and having to order whether that happens or not. And what we've seen with pensions as well recently is the delay in obtaining NHS pensions. So teachers' pensions still taking a long time. When I'm talking about that, I'm talking about the time it takes to wait for the cash equivalent of used to come through, so that you can help work out what's in the pension and then needs to be divided. So they're taking, I think last year we had one that took 9 months on an NHS scheme to come through, because they all had to be recalculated as a result of some case law, and therefore it was taking much longer.
It's really hard, and it's really delays people moving on with their lives, doesn't it? They're just stuck waiting for pension reports and cash equivalents.
It can take months. It can, even in a best case scenario when you can obtain pension reports, it can still take 3 to 4 months. So you factor in public sector waiting times. Took us nearly a year on a particular case to get to that point, and then you're trying to negotiate at that point, and then if you have to issue proceedings anyway, you're really far down the line. So you're not ideal, but things are improving slightly. But with teachers' pensions, I have still noticed quite a delay on getting the reports back, the CVs.
Yeah. I think often as well, people don't think about the pensions till nearer the end.
We do.
And so we've had a client recently, and the settlement is basically agreed, and then it was, we're just going to split the cash equivalent values, and then we pointed out that it was a defined benefit pension, and perhaps they should look into that in a bit more detail and get a report, which they're now doing, but they were sort of all ready to do the consent order, and now they're waiting
on an offsetting type basis. Yes, they want a cash, just pound per pound analysis.
Yes, half pound analysis.
Yes, easily, and they can do that, don't they, or not? And it's really not possible. No, some pension schemes are worth much more than they say on the tin.
Absolutely.
Yeah. We've had, and also just with the CVs that come back previously, probably pre-withheld for NHS pensions, we were getting second opinions on those, and they were coming back 3 times higher because they weren't factoring in the CPI and the price increases. So it was difficult to even just rely on the NHS scheme and see these themselves.
And at least that's what the actuaries will do. They'll look at the actual CE and make sure it definitely makes sense.
The safest option is always to get some financial advice and an actuarial advice if needed. I think so, yeah. So that's something that crops up on most cases if the parties are willing to go down that route. So if they don't want to go down that route, we have to get parties to sign disclaimers, because we can't be held responsible for money that they could have achieved in settlement that they choose to ignore. So with that situation where you have got someone who's sort of thinking, well, I don't want to touch the pension, do you forecast for them then what life would look like without it? You can get reality checks and then maybe they change their minds.
Yeah, that's exactly what we do. Yeah, and say, look, this is what retirement looks like.
Yeah.
And we do forecast if they're going to be working and saving towards a pension. We put all of that in. But yeah, it's just, you might need to downsize before retirement to free up some money. But sometimes even if you do that, it could still be a shortfall in later life. So
yeah, because it's a long time. If you think you're retiring in your 60s, if you're forecasting to 99, it's a long time to. It is, yeah, especially if the expectations of holidays and things are there, and lifestyle and that's another thing I was going to measure, university costs for children, and with the ageing population and people having children later, they're often retiring around the time that their children will be going off to university, and that's a huge expense to factor in.
Yeah.
University fees now I think are going up with the loans and things, 100,000 for a course, and it's so much money, isn't it?
It's really expensive. And the accommodation, even if the child themselves gets a loan for the course, you still got the accommodation, and the maintenance grants are on quite a low. Not everybody gets
right. Wrong guess them.
And I think that expectation versus reality, yes, is quite a lot of the conversations that we have. There are some that we're giving peace of mind to, like we said earlier, but a lot of the time it's about readjusting the expectation that the children might not be able to stay in private education all the way through. The holidays might need to change slightly, other type of holidays, because the dual income isn't there anymore. You've got to split that into running 2 homes. And
I suppose it's just so important to get forecasting at the beginning from both the pensions point of view and from a general affordability point of view about what life will look like, and that really assists with negotiations. And in some cases you might have a case where there is the money there to do this, but the other side perhaps is very reluctant to share things on an equal basis or share things at all, or perhaps it's predominantly you might have a business owner manager who a lot of the money's tied up in the business. There's lots of money there, could be a multi-million-pound business shareholding, could be worth millions, but the actual cash isn't there straight away. So we have situations where we might settle, but it's on the drip, so you'll have a lump sum by instalments being paid over the 5 years, and that's something to think about as well in terms of forecasting if there's any uncertainty about that lump sum being paid, or so it's when money is tied up in that way, it's often a result. Often the result is a lump sum payable by instalments or a series of lump sums. So sometimes the money is there, but it's hard to get at. Or it's just about finding creative ways, and if you can find those ways, cases can settle. But
what's really nice for us with cases, if a client, is a bit beside themselves at the beginning, doesn't know how they're going to work or how the maintenance, how they're going to live on it, and we'll run the modelling, and really we end up coaching them quite a lot as well, don't we?
Yeah.
And then once you've taken them through that whole process and they've settled, and then seeing them again 6 months later and actually, everything you said, actually I can live on this and I'm doing okay. We went on holiday 3 and seeing the change in them mentally, is really nice.
Yeah, it's really good.
And I suppose that means that you can help them throughout their life, and they'll come back to you in years to come for more advice and investment advice or whatever it is they're doing at that point in their lives, or pensions advice.
Yeah, I think with a lot of clients, we start working with them in the beginning, and then we work with them post-settlement as well. So once they've got their pot, whether it be a pension share or capital amount, we then work with them to get it invested, to be put into the right pension, invested in line with their time frame and what their plans are, and generating the income they need sometimes in the most tax efficient way. Brilliant. So our work doesn't stop when they've settled. In fact, it carries on, and we get to sort of work with them as their life progresses and they start their new chapter.
Yeah, it's nice. And that's, people say, I don't know how you do your job, but it's actually really rewarding, because I see people come out of the other side of a traumatic experience and they're much happier than they were when they came to see me a year ago, whatever it was. And it is quite rewarding in that sense. And you get to live it through with them, even beyond that point of separation and finishing the consent order or the court order. You get to see them for much longer. So that's It's really nice.
So it is really good going on that journey with them, isn't it?
Yeah. And also knowing when you meet new people at the beginning of the journey, being able to say, you know, this will get better and you will understand all these figures, and it's really overwhelming right now, but it will start to feel better. And that's part of our job, is to make you feel less overwhelmed and to help you to understand what your future looks like.
I think that's something I've often say at the beginning as well. It's some people have already sort of gone through that trauma some time ago, and they may have separated years before, and it's, you know, they'll come to it's very factual, but others it might just be really recent. And something I always say to people is that you'll look back and you'll think how far you've come, and your life will be very different in a good way. It's always the case. I haven't seen anyone come out of it, you know, in a worse state than they started, because it's the worst point when you first go to see a solicitor or anyone to do with separation. You may not have seen a solicitor before in your life. You may not have been to a solicitor's office. It's really daunting. So it is a rewarding job in that sense. I love helping people like you do, especially people in that that situation. But thank you very much for coming in to talk to me today. It's been really insightful. Really enjoyed our chat.